All right, so welcome to Learning Objective 3 in Chapter 3. We're actually going to do accounting today because accounting starts in something called a journal. Okay, but look how much we had to know before we could actually get to this point of actually now starting to do accounting. You had to know all those accounts. You had to know how to do the transaction analysis. And then just most recently, you had to know, okay, once an account is affected, is it affected on the debit or credit side? That's the debit and credit analysis. So you had a lot of knowledge to build before we could get to actually doing accounting. But today is the day because everything in accounting starts in the journal. Okay. The journal begins the recording process. And the numbers are going to flow to other places from there. But this is where it all starts. Okay. So basically, after we analyze the transaction, which you've been doing, okay, the next thing is we enter this transaction into the journal. So this is actually the focus of Learning Objective 3. After we learn how to do this, we'll move on to Learning Objective 4, which is actually moving the information from the journal into something called the general ledger, which you'll learn about next class. So we did a lot of analysis. This basically shows us how far we've come. Lots of analysis, and today we are going to be doing the journaling. Okay. After the journaling, there's a little bit more to do. Again, this is part of Learning Objective 4. I don't have to worry about that right now, but this is what we're doing in this objective. Learning Objective 3 is all about this step here. Okay. Transactions are recorded in the journal first. It's actually often referred to as the book of original entry, at least back in the day. And so everything is recorded in the actual order in which they happened. At least that's the that's the deal that it's supposed to be. So everything is recorded in the journal. That's the very, very first stop. And so it gives us a complete record of all the transactions that occurred on a particular day in a particular company. Okay. And it actually is a great source for finding and locating various errors that happen when we do auditing and analysis, which is not something you have to worry about per se right now. So the process of putting the data into the journal is what we call journalizing. You're simply, when you say it's time to be, they want you to journalize these transactions. It simply means you're analyzing the data and putting that data into the journal. So this is an illustration on how to do that. If you have your book handy, you're going to see that what we're doing is on page 107. Page 107. Okay. And we're going to stick with our Sierra Corporation model that we've been using for the last couple of chapters, but the details of the transactions that occurred for Sierra Corporation happened in Objective 1 in this chapter, where on October 1st, they issued common stock for cash. Now, we have analyzed this. You said, okay, we have more common stock and we have more cash. And so now that you know that the cash account shows more on the debit side, we know based on our last objective that we're going to be debiting cash for $10,000 because we have more cash. We also know that common stock, being a stockholders' equity account, increases on the credit side, and we have more common stock. And so we're going to credit common stock. So this is all the stuff we had to analyze, right? Once we saw this transaction. The step that we have to do next is journalize, and you'll see how that works very shortly. The next thing they did, Sierra Corporation borrowed $5,000 with a note. We analyzed that. We said we had more cash and we had more notes payable. You know, with the debit and credit analysis from last class, that more cash happens on the debit side. So we're going to have a debit to cash for 5,000, and notes payable are liabilities. They increase on the credit side. We have more notes payable, so a credit to notes payable. This is all the analysis we've done. And then, of course, this last one here on October the 2nd, they purchased equipment for cash. We know we have more equipment, but we also have less cash. Equipment and cash are both asset accounts, meaning that they increase on the debit side and they decrease on the credit side. So we have more equipment. So a debit to equipment for 5,000 shows we have more equipment, but we have less cash. So a credit to cash shows we have less cash. So now that you've done all that analysis, it's time to actually do the accounting. This is what the general journal would look like. It has usually 4 columns. Sometimes that reference column is there. Many worksheets in this book don't have it. But you'll see what that's for in a little while. Everything always starts with the date, because remember, the journal records things chronologically. As they happen, we're writing these things down in the journal. So, things that happen now are going to be recorded before things that happen, this afternoon, which is going to be recorded before things that happen tomorrow. So it's all chronologically based. So what happened in that first, very, very first event is, as we've analyzed, we have more cash, we have more common stock. You did your debit and credit analysis. More cash is debiting cash, 10,000. More common stock is crediting common stock, 10,000. In the journal is where we actually write it down. So the date goes first. The account titles, so that's the actual names of the accounts, right? Specific accounts. You can't put assets and stockholders' equity. Those are not accounts. They are types of accounts, but they're not names or titles of accounts. So we have more cash, more common stock. Notice, and I'll get to this column soon. You'll see it in Learning Objective 4, how it all comes in. Notice where the numbers go. The last 2 columns are where the numbers go. And as you notice, the debit column is listed first. The credit column is listed second. So we always write the debit in first, because the numbers are going to go into the debit column first. So the debit to cash for 10,000 is going to be the first line. The second line is for common stock, and that, of course, that 10,000 is going to be on the credit side of common stock. And so the credit of 10,000 to common stock is listed second. Notice there's a little bit of an indent. Usually the very first account is the account that's being debited. It's usually kind of flush against this margin here. We indent that second one to show that's where the credit is going. And so that's what you'll see oftentimes in your book. But this is how far we've come from analyzing a transaction, knowing what accounts are affected, doing our debit and credit analysis, and now we're putting it in the journal. The journal is actually the very first place that accounting starts. Here we have the $5,000 that we borrowed with the note payable. We analyze that. Again, when you get that loan approved, they're giving you the cash that day, so you got more cash. But now you have a note payable that's due in 3 months. And so we have more notes payable. We analyze that. More cash is shown on the debit side of the account. So we're going to be debiting the cash account for 5,000. Notes payable as a liability increases on the credit side. So we're going to credit notes payable for 5,000. That's all that analysis that we've done till now. Then again, the date gets put first, because again, the journal is chronological. The first account is the debit side of the account. So cash is going to get the debit for 5,000. A little bit of an indent. Notes payable getting the credit for 5,000. This is how the journal would look. This is the journal entry for that transaction. This is the accounting and bookkeeping that we're doing now. And in the very, very last example here, although you're going to be doing these over and over again for a while, so you'll get good at it. You have to. You have to. This is the one of the major skills that you're learning in this class. Um, and so it's very, very important that this work for you. So we purchased equipment for $5,000 cash. We have more equipment, as I said. We had less cash, right? Both are asset accounts, so more equipment is on the debit side, right? Asset accounts increase on the debit side. So the fact that we have more equipment means we're going to debit the equipment account. We have less cash, cash decreases. All assets decrease on the credit side. So we're going to credit to cash. So here we have the date of October the 2nd. Equipment account is debited first. A little indent here. The cash account is credited, right, for 5,000. And this basically is journaling. This is basically how accounting works. Now, once you actually print out the journal or look at the journal in a large sum, these pages are quite big. You'll see here everything is chronological. You'll see the account titles are listed. The account that's debited is listed first. The account that's credited is listed second. Again, the debit column is the very first column. The numbers are going in. The credit, and that's listed first. So we list the debit side first, credit side second. Okay. But this is how a journal would look. I mean, these are quite long, if you printed them out, they'd be very, very long pieces of paper to look at. But each of them tell a story. Now, this particular journal has the explanations given at the bottom here. I mean, it's totally optional. I mean, I at this point, you might not know what this is, so having an explanation is a very good way of teaching you what just happened here. But as you get much better at this and you get used to this, you'll know what that means. Maybe you won't need an explanation. Okay, so journal entries. Do it exercise 3. If you're following along in your book, which would be a decent thing to do, this is pages 108 and 109. I really just do not like writing with my finger here. So here we have Kate Brown's beauty salon. Here it is. And I must have gone to their competitor here, her competitor. Here it went, because it's going. This is the first month of business for Kate Brown, and it looks like 3 things happened that they want us to analyze and do the journal entries for. Okay, so the first thing, again, this is a corporation incorporated. So corporations start by stockholders or the owners putting cash in, and they get shares of common stock. That's how corporations start across the board. So we definitely know that cash and common stock are affected by $20,000. How would it look on a journal entry? Well, again, this is not a proper journal, but it's just what they have here. So in terms of the first entry corresponding with this, we would have a debit to cash. Get them just in your head. Know that this is the debit column and this is the credit column. Okay. In the journal. So we have a debit to cash for 20,000 and a credit to common stock for 20,000. And that is exactly what happened here. More cash means cash is debited by 20,000. More common stock means common stock is credited by 20,000. So this is exactly correct. Look what happened in number 2 here. We purchased a lot of equipment, $4,800 of equipment on account. There's a little 2-word phrase that comes up quite a bit in accounting, right? And you buy, in this case, we're buying on account, which means we actually were able to take the equipment back to the company. But now we have a bill to pay that's due in 30 days. And you know what bills, when we have a bill to pay in 30 days, we call that an accounts payable. Right. So here we have a lot more equipment. So equipment is an asset account. We're going to be debiting the equipment account to show more equipment. This means we have more accounts payable. Accounts payable is a liability. Liabilities go up or increase on the credit side. So we're going to be crediting the accounts payable here to show an increase in accounts payable. Okay, so that corresponds with that. This would be the journal entry. Again, the debit account is listed first, the credit account is listed second. And the third thing that happened for Kate Brown's salon is she interviewed people for the stylist position. So as you know, it doesn't matter if you interviewed or hired someone that day. No, you're not cutting a check to anybody. You're not, there's no financial effect when you interview or hire, whatever. And so in this case, there's no entry because it's not a transaction. It's not a transaction. Okay. So let me bring us back to the main screen to see how you're feeling about the journal at this point.
So for this section, it's mostly about placing the where and what. It's about placing the stuff and placing it in a certain order. That.
Well, you're just basically, all the analysis we've been going through, where we concluded that, one account is going to be debited by a certain amount and another account is going to be credited by a certain amount. We're just simply writing that down. The journal is basically simply writing down all the analysis we've been doing over the last couple of weeks.
I have a question.
Yeah, Clark, go ahead.
All right. So this is the complicated process. So at what point does a business go through all this trouble? Like if your business is like, if you make under 100,000, you go through all this trouble. At what point do you start to use certain types of accounting? Is there like a marker?
Well, so the focus of this particular book is teaching you what's required for public corporations to do in terms of how they handle things. Small businesses, sole proprietorships, partnerships, it's more likely, first of all, they're not going to be using the accrual basis of accounting, which is what we're learning here. They're actually going to be probably using the cash basis of accounting, which means they're simply going to look at all the cash coming in and cash going out, and that's how they're going to be doing their journal entries.
So just the
Um,
like,
so this is specific to the corporate form, and even more specific than that, what's required by GAAP for public companies to do its financial reporting. So, and our world is, I mean, there are more small businesses technically than corporations, but our world is almost always more dominated by corporations, at
so
least.
this is the information that's given to the SEC. Only companies that are required to report to the SEC would have this. Pretty much,
Yes.
the rest is private, so you don't even know. So it's probably
Well, I think if it's a private corporation, that's they would be needing to do a lot of bookkeeping as well. It's not like they're not doing any bookkeeping, but because they're not publicly reporting their earnings and other stuff to investors or the public in general, um, they don't necessarily have to follow every single rule that you're seeing here.
okay. That makes sense.
Okay, so that's basic. So we are looking at things from a particular perspective, but this is if I was a small business and how it's different, I probably would be using my checkbook or my bank record um, and maybe some other papers that I have. Like you were saying, you put your papers in these folders. I probably would be looking at that to sort of track how to do my journal entries. what accounts are affected on a particular day. That's called the cash basis of accounting, and that's perfectly legal to do. It's just not what corporations that are public can do. So it's a little bit of a different system. In essence, it's almost an easier system to understand because everything is based on cash. When the cash is coming in, you say you earned money. When the cash is going out, you say you paid for something. That's not how that's not how what we're learning here in this regard. Okay, it's trickier. It's trickier. And because corporations also need to be, they require a lot more accounting services. Accounting firms help and make a lot of money from their relationships with larger organizations like public corporations. This is more reasonable to teach, and people that that might be working at some point in time in accounting at either a corporate firm or maybe an accounting firm, these are probably the things that you probably need to understand more. Again, the other way of doing it, the cash basis, is a much simpler way of doing the same thing. We're still doing the same thing. We're still journaling. We're still doing all the other things. We're just doing it differently. So, well, let's get back to the journal here. And to Adam's question, basically, look at all the things we've done in the first two objectives, right? We've read we've read about an event. We had to decide if it's a transaction. Most events have been transactions, as you know. If it's a transaction, then we have to do the analysis. What accounts are affected? How are they affected? Is there more or less in an account? Then we had to apply our debit and credit analysis. Okay, if there's more cash, how do we say that? Well, debiting cash would mean more cash. If there's more accounts payable, how do we say that? Well, that's the credit side of the notes payable accounts. We would credit notes payable. That's all the analysis we've done. Now we're simply marking it down. I mean, there's no extra work to do per se. All the hard work is behind you, in essence. You've already gotten to this point where you can sit and analyze a transaction, and now you're just writing it down in the journal. This is basically where accounting is starting. That's basically, I mean, I don't want to do too much too soon. I don't have to with you. And today's a perfect day to sort of give you like lots of journal work to do over the weekend. Not that you had plans for the weekend, because you all know, your plans are, you have a date with Wiley, as you know. You have a date with Wiley Plus. Every weekend, every day, you have a date with Wiley Plus if you wanted one. And so there's more of that coming. So if there are no further questions on the journal, then I'm going to start assigning your homework and getting you started.